So a quick Google search on US dollar collapse yields 183 million results. Obviously, some folks are writing some provocative articles out there about the dollar, and there's been plenty to create a stir recently. Russia, China, Brazil, Iran, to name a few countries, well, they don't like it when the US uses the dollar to impose economic sanctions. So they've been meeting off and on, trying to decide if they can use a different currency than the dollar, maybe to conduct some of their transactions. In addition, the debt ceiling debate created its only short-lived crisis narrative. It seems like there's always a political season in the U.S. with politicians and the media looking to grab attention with fearful and ominous projections of what could go wrong, often showing a very skewed picture of reality. One of our recent favorite chart crimes, as Jason Zweig calls them, occurred in a Bloomberg editorial where the author was making the case that the usage of the U.S. dollar as a reserve currency was in serious decline. The chart appearance suggested that the decline was over 75% since 1999, but on a closer evaluation, the scale of the chart ran only from a low of 56% to a high of 74%, rather than from 0 to 100. When you redo the chart data and show the full range from 0 to 100, the actual decline over 23 years was less than 20%. Hardly a crisis, but a good reminder that all charts are not created equally or objectively. Now, other signs of the dollar's strength can be seen in U.S. Treasury debt sales. So-called indirect bidders, they're considered to be a reasonable proxy for foreign investors in our country's bonds. In the week before the U.S. Congress came to an agreement on extending the debt ceiling, the demand for U.S. Treasuries at the regular debt auction was still higher than average, and in the shorter, higher-yielding maturities, as high as it's ever been. You know, the dollar's value is sometimes thought of as a representative of global investor sentiment relative to the country's economic prospects, kind of like valuing the U.S. as a stock. Now, while there may be some who raise fearful voices, the overwhelming consensus of the broader market is that the U.S. is still the largest and healthiest economy in the world. This helps make the case for a strong dollar relative to any alternatives. Finally, the dollar is still a pervasive currency for foreign reserves and for use in international settlements. The rest of the world still views the U.S. dollar as reasonably secure and stable because our government is seen, believe it or not, as stable, and our economy is viewed as relatively strong. This was one reason it was so important that we resolved the debt limit problem in June, so that our Treasury debt in dollar would remain the standard, and global trading partners could remain confident in its value and its stability. So with that backdrop of what we think of as a strong dollar, what does this mean for investors' portfolios? Well, we think it might be helpful to understand what it means for markets when the dollar is appreciating or depreciating relative to another currency. I've asked our Director of Investments, Michael Westphal, to help us out. This is kind of a currency 101. So Michael, what do we need to know?
Well, currencies can be really confusing. If we're talking about the euro and US dollar currency pair and it goes up, does that mean the dollar appreciated or did the euro? In my mind, I like to use gasoline as my pseudo-currency. We talk about the price of gas in dollars per gallon every day. I know that if it was $3.50 a gallon last week and it's $3.25 a gallon today, it's the price of gas that went down. The dollar didn't appreciate. I have $1 and it buys more gas not because of any movement in the currency. Similarly, we can talk about the exchange rate between the British pound and the US dollar and just substitute British pounds and gallons of gasoline.
So what impact do these currency fluctuations have for U.S. residents?
This may seem a bit more complicated, but kind of remember the gas example and substitute that foreign domiciled stock. Let's take a look at Sony trading in Japan. First step to do would be to convert dollars, because I have dollars, to the local currency. Using Sony as the example, the Sony is trading for 14,000 yen on a Japanese exchange. If we needed 100 shares, I need 1.4 million yen. But since we have dollars, we look at the exchange rate. We can buy 140 yen for every $1 I have. That means we need $10,000 to buy 100 shares of Sony in Japan. Our investment can move if the share price in yen of Sony rises or falls. I mean, that's easy enough to understand. We see stock prices move every single day.
Okay, so we get it. We see stock prices moving. So let's create a fiction here for a second. Say Sony's stock price does not move, but the currency, the exchange rate between the US dollar and the Japanese yen does move. What happens then?
Well, let's say the dollar strengthens by 1%. If that's the case, then now my $1, it buys 141.40 yen. And if the stock price stays the same, we can still sell those 100 shares of Sony for 1.4 million yen. So now we just need to convert this back to dollars, and that gives us $9,901. That's a $99 loss from the original $10,000 investment, and that's only due to the exchange rate change. And it works the other way too. If the dollar depreciates, the share price stays the same, we'd have a gain on our Sony stock.
I think that's kind of the interesting thing, or maybe the complicated or hard things for us to understand, because we see everything in terms of its price in dollars. But when we're converting currencies, there's two things that can potentially happen to the value of the investment. The investment, in this case Sony, that share price could move just because Sony's doing better or worse. At the same time, the currency exchange rate between dollars to yen, that can move for a whole raft of other factors, that kind of relative strength between the two countries' economies. So what happens then is we have, there's two variables here. What's happening with Sony, what's happening with currency, and they're both impacting the investor portfolio. So when we see that variation change and we think about that as an investor, what's the takeaway for how we think about our investments?
Well, as a US-based investor, the dollar is our home currency. We get paid in dollars. We go to the grocery store and we use dollars to buy our groceries. So if your home currency strengthens or appreciates relative to a foreign currency, it reduces your return when it's converted back. Similarly, if it weakens against the foreign currency, it increases the return when it's converted back. Over the long term, exchange rates, the strength of currencies relative to each other, has proven to be very unpredictable and basically cyclical, meaning no long-term trends. Holding foreign stocks in local currency on local exchanges can be a nice hedge against currency movements. For the US investor, if the dollar weakens, all other things being equal, the value of the foreign portfolio should increase.
I think that's also a really good point. Some people have asked, hey, what should we do to hedge against maybe a dollar devaluation? In many cases, if you hold foreign stocks and you're buying them in the local currency, which we do in portfolios here at Foster Group, you're engaging in a bit of hedging anyway. Because just what you were saying, if the value of the US dollar goes down, the actual return, all things being equal, of those foreign investments should rise. So what about non-portfolio impacts on US residents?
Well, when the dollar strengthens, US consumers can buy more foreign goods or purchase those imported foreign goods for a lower price. It also makes American-made goods more expensive for foreign consumers. If the dollar were to get too strong, it could worsen our trade deficit. But if the dollar weakens, foreign goods become more expensive for US consumers and could prolong an inflationary environment. One bonus though, with the currently stronger dollar, US citizens can travel overseas for less when converting their dollars to, say, euros or British pounds.
Yeah, I think this is really interesting, in part because there's so much conversation about the value of the dollar and what impact it might have on US consumers or US investors. One thing to remember, and you mentioned this, Michael, is that those currency fluctuations are generally pretty cyclical. They kind of come around. One currency will appreciate or depreciate relative to the other. We also don't see a lot of significant changes over time, where, especially in short term, where that dollar change is going to make a big, big difference in a sudden kind of a way in an investor portfolio. They tend to be smaller changes around the edges. But again, that kind of hedging aspect of owning foreign stocks in the home currency can really help us out. One thing you said there at the end was about vacation and travel. Talked about being maybe less expensive to travel to certain locations. And that's a good summer-related thought to end on today. I came across this thought recently about why we need vacations now and then. Someone said, a vacation is what you take when you no longer can take what you've been taking. Think about that a little bit. We hope you can take the time to get away this summer for some rest and some fun with family and friends. We also hope you'll continue to join us here on Financial Perspectives. If there are questions you'd like to hear us address, like this one about foreign currency, please let us know at some of the contact information you see on the screen. We'll be back in a few weeks. Until then, be well.